Hello class, welcome to this chapter 2, handout 3, answer video. And you're going to need your handout and you are also going to need your journal entry page because this handout is all about practicing journal entries. I'm going to walk you through them one more time. Hopefully you have tried this, as I said before. Try to get these journal entries on your own. You're just here to check your work. So let me share my screen. And let's get started. Open up my journal page here. All right, here we are. So, Mona lists chemicals engaged in the following transactions during December. So on December 2nd, our first one, so on 12/2, they paid rent on office furniture in the amount of $1,200. So our amount is $1,200. Furniture is needed for an office. That's an ordinary cost of doing business. So we have a rent expense. And since they paid it, we have cash. Those are our two accounts. Rent expense. Expenses are the first E in dealer, normal debit balance. Cash is an asset with a normal debit balance. So to decrease it, because since we're paying it out, we need to do a credit entry. The amount of $1,200. Next, on December 3rd, borrowed $25,000 on a 9-month 8% note. Okay, so here we borrow money, $25,000 is the amount. If we borrowed it, that means we receive cash on a note, meaning we are going to pay it back later, which creates a liability, specifically a note payable. So to increase our cash, which is an asset, we need to make a debit entry to cash for $25,000. And we also need to increase a liability. Liabilities with that normal credit balance gets a credit entry for $25,000. Next, on 12/7, provided services on credit for $42,600. We know the amount there. Since services have been provided, that is called revenue. So we have some service revenue. Revenue is the R in dealer, so it has a normal credit balance, but it is on credit, meaning we did not collect any cash yet. People owe us the money for the services provided. So we are going to increase our asset of accounts receivable. To increase an asset, we make a debit entry. To increase our revenue, in this case, service revenue, we make a credit entry in the amount of $42,600. On to 12/10. 12/10, we purchase supplies on credit for $28.50, which is our amount. We received an asset of supplies. Okay. But we did not pay cash for them yet, so that asset is not going down. Instead, we got them on credit. Not a formal agreement with interest, so this is a liability that we owe later that we are going to call accounts payable. Okay, so we need to increase our asset of supplies with a debit entry. We also owe more money, so we need to increase our liability of accounts payable with a credit entry. Or $28.50. On 12/13, collected accounts receivable, $20,150. So accounts receivable was money people owe us. Okay, so now we collected it. They do not owe us anymore. So we are increasing our cash, but we are decreasing the amount of the receivable since they do not owe us. So to increase the asset cash, we make a debit. To decrease the asset accounts receivable, we make a credit in the amount of $20,150. On the 19, we issued common stock for $50,000. Okay, when we issue stock, that means people are giving us cash to become an owner in the company. becoming an owner increases equity. Okay, so our cash is going up by $50,000. Balance out that accounting equation here. Our equity is also going up by $50,000. We're going to call that account common stock because that is what went up. That's what the owners got. So we will increase our cash with a debit, increase the equity or the common stock, which is the second E in dealer, which has a normal credit balance, by that same amount, and the amount is $50,000. In 12/22, we paid employee wages for December in the amount of $13,825. Wages are a normal cost of doing business. Paying them out creates an expense. Expense is the first E in dealer, so that is a normal debit balance. So when we increase our expenses, wages expense, we make a debit entry. It says they gave them cash, our cash is going down. To decrease an asset, we make a credit entry. The amount is $13,825. Next on 12/23. Paid accounts payable of $1,280. So in this case, we had a liability before somehow where we owed some money, but now we owe less because we're paying it off. So actually what we owe is going down. To decrease a liability, since it is a normal credit balance, we make a debit entry to that. So we will debit our accounts payable to make it go down. But we also paid out cash here, so our cash is decreasing. To decrease an asset, we make a credit entry. The amount is $1,280. 12/25, nice to see they're doing business on Christmas Day. Provided services with cash in the amount of $13,500. So here we provided services. And I keep saying this a lot, so I want you to understand, anytime services provided or goods are delivered, that is revenue. Okay, revenue is the R&D with a normal credit balance. We did it for cash, so we actually received cash. Our cash is increasing. Cash is an asset. To increase an asset, we make a debit. And again, we have service revenue here because we provided the service. In the amount of $13,500. And finally, on 12/30, we paid utility bills for December of $1,900. The utility bill, that is the normal cost of doing business, that creates